Hi guys, this is Sandy. I'm a licensed realtor here in the Central Florida area. Today I want to do a video for you on how to finance a second home, especially people from New York. My New Yorkers! Anyway, so let's say you live in a colder climate and you want to have a home in a warmer climate. Good example would be I live in New York and I want to have a vacation or summer home or second home in Florida, or maybe you want to have a second home on the beach or whatever the situation is. So you want to buy a second home, but you still want to keep your first home. There are various financing available for that, right? And you have to decide, what are you going to do with the second home? Is it going to be a personal second home where you're the only one living there? Or do you want to use a second home for Airbnb? Meaning you're going to use it for short-term rental, which means when you're not at the home, you're going to rent it out to different people. When you're not in the home, you're going to rent it out, and when they're gone, then you're going to stay there. I need coffee this morning, guys. Okay, you get what I'm saying, right? Right. So there's two ways to finance. The bank is going to ask you, is it going to be a second home, normal second home, or is it going to be a second home that you're using for Airbnb or short-term rental? If it's a regular second home, whereas it's just you and your family, then there's various ways you could do to finance it. You could take out an ELOC, which is a home equity line of credit from your current home to buy the second home, to get the funds to do that. The bank is typically going to want a minimum of at least 20%. Some banks will do 15% maybe, but most of the time you need 20% to put down on a second home, right? If you're just going to live there. The same thing happens if you're gonna use it for investment. So let's say you live in New York and you want to buy a home near the Disney area or maybe on the beach in Florida, and you're going to come down and live in that home sometimes, but when you're not there, you're going to be in New York and you probably want to make some money to probably cover some of the expenses of owning the second home. So you're like, okay, I'm going to use it for Airbnb or short-term rental or something like that. You could do what is called a DSCR loan for such a purpose because it's really an investment property. So you could do an investment loan. So there's two different kinds of loan. There's going to be a loan for a second home, which means it's your personal second home. And then there's another loan for it's going to be a second home, but you're also going to use it as an investment property, right? The two different kind of loans. So you got to decide which way you're going to go with that. However, for the most part, whether you're going to use it personally or you're going to use it for investment, you probably will need a minimum of 20% down. If you're doing DSCR loan, meaning you're going to buy it and you're going to use it for Airbnb sometime and live there sometimes, you probably maybe might need 25 to 30% down based upon the long-term rental history of the property, right? So based upon the area you're buying the property, and they're going to take a look at the rent, how much it would be able to rent for monthly. Not an Airbnb, but monthly. That's what they're going to go by. Now, if you're buying a home as a second home, but it was already the person that owned it before you, the seller, is using it for Airbnb or for short-term rental, and they have a history of financing on that property, then you might be able to use that to be able to bring down your down payment. Because if they have a history of income and you send that to the lender, they're going to use that to say, okay, this home produces X amount per month. They're going to also take into consideration how long you are going to be living at the home. So how long will you be living there as opposed to how long will it actually be renting? Because the bank is going to or the lender is going to try to mitigate their losses. So they want to know, okay, if this property is doing $2,000 a month, but 3 of those months you're in it, say it's only going to be doing $2,000 for 9 months, that's a different income ratio as opposed to $2,000 a month for 12 months. If you're going to do a regular home, that's a different story. The interest rates tend to be a little bit higher on second homes only because it's not your primary residence, right? So if it's your primary residence, it's easier, better. If it's not your primary residence, it's a second home. Guys, it doesn't pay to give false information on this, because I see a lot of people coming into Florida to buy a home, and they say it's going to be a second home, and then when they realize they have to put more down payment down or it's going to be more interest rate, they switch to, oh no, we're just going to use it as a second home, or we're just going to live here. If you're in another state and you're buying a home in another state, so you're in New York and you're buying a home in Florida, and you're telling the bank that you're going to be living there, even though you know you're not, that's illegal, number one. Number two, you're going to have to prove to the bank where you're going to be working. So if you're saying you live in New York and you're going to buy a home in Florida and you're going to be living there, are you relocating to Florida and do you already have a job there? So that's going to be a whole different ball game. So it's best to play the game fairly, right? So you're gonna need at least 20% down to buy the second home. But there's many banks that will finance it with 15% down. There are a few banks that might be able to finance with 10% down on a second home, but that means your debt to income ratio has got to really be great for the bank to do that. The same kind of mortgage can be used for a primary residence and also for a second home. You could do a 15 or 30-year mortgage on either one of them. But for the second home, the bank is going to be looking a lot on your debt to income ratio. So let's talk about that for a second. If you're buying a second home, and it's just going to be your home, you're not going to rent it to anyone, it's just you and your family going to enjoy it, that monthly payment is going to be a part of your debt to income ratio, which means the bank is going to take into consideration the current mortgage you're now paying, assuming you're paying one, the mortgage that you're going to be paying on the second home, any credit card or car payment or student loans that you currently have on your credit report is going to count as debt. Okay. Now there's a new rule they came up with response to medical bills. Some medical bills they may take into consideration, some they may not. A lot of gray lines with that, so we won't go into details with that. But if you have medical bill on your credit report as well, then that may also be taken into consideration, which is the reason why you have to make a higher down payment most of the time on a second home, because your debt to income ratio gets higher. And since there's no income coming from either homes, there's no income coming from your primary or your secondary, then the bank is you're going to have enough income to prove to the bank that you could absolutely pay both mortgages, unless you get another family member to co-sign to help you with the second home. You could do a 15 to a 30-year mortgage. You could, if you have enough equity in the primary residence, you could pull what is called a home equity line of credit, which is ELOC for short, and you could borrow against that. And that's typically between a 10 to a 20 year, right? So you start drawing from it, and after a certain period of time, if it's not paid off, the bank may spread it out to a 20 year. So then you end up with 3 loans. You end up with the mortgage on your first home, the ELOC loan, and then the mortgage on the second home. So you got to really be careful when you're thinking about buying a second home, how you're going to gear it. That's why a lot of people, when they buy their second home, they use it for short-term rental or for Airbnb when they're not there, to help them to offset some of this income. And if you buy it that way, the bank is more lenient, because they know that you have the potential of getting income from the property, so they're not going to look too much on your salary, right? Your debt to income ratio is going to improve, because the income from the second home will help you with income coming in the eyes of the bank, right? So that's how you kind of get around that. So if you're looking to buy a second home, you have to look into what is your debt to income ratio, what's showing up on your credit report, how much debt do you have to cover each month, and if you bought the second mortgage onto your debt portfolio, let's just say, you have to have enough income to buffer that, and it has to meet the bank's debt to income guideline. Each bank is going to have a different debt to income guideline. If you do Fannie Freddie have the same guidelines, but once you start to go across that into more creative financing, if you will, like a DSCR loan. On the DSCR loan, this is a loan that you could use to purchase investment properties, including buying a second home and using it sometime for Airbnb or short-term rental. They don't really go by a debt to income ratio per se. They more go by the income coming from the home. But in order for you to use short-term rental income, the property must have already been on the market by the seller and have history of that short-term rental income. If it does not have history of the short-term rental income, the bank is going to go by what's the average monthly rent for the area. And of course, the average monthly rent for the area will be lower than the Airbnb rent. Because obviously, if you have the property in Airbnb or short-term renting, you're going to charge more than if somebody's consistently paying you $2,000 a month. So let's say a home does $2,000. Let's say the average rental on that property in that area for long-term is $2,000 a month. If you're doing short-term or Airbnb, you might double or triple that $2,000. So you might get $4,000 a month or $6,000 a month. But the bank is not going to take that into consideration unless the person you're buying the home from has a history of it being on the market and can actually pull something from Airbnb and give to the lender to say, hey, here's what the property has been producing, and that's what we're going to do. They're going to also they're going to also take into consideration how much months it was active on the short-term rental platform, as opposed to how long the owner was living there. And they're going to also want to find out from you how much time of the year or what length of time of the year are you thinking of living there? You're going to be living there for a month, 2 months, you're going to do all summer, you're going to come for Christmas. Because also another thing to consider is the home is going to rent more in the busier season. The busier seasons are going to be spring, summer, and the holidays like Christmas, Thanksgiving. So if that's when you're thinking of using it, then you're not going to really make that much money from it. So then the bank is going to more look into your debt to income ratio. Can your salary cover all your debt? That's what they're going to look at. So these are things to pay attention to when you're looking to buy a second home. It's a great idea. A lot of people do it. Maybe you're rich enough to just buy the second home cash. You need no financing. This video is all about if you already have a finance on the first home and you're looking to buy a second home. The rule of thumb is distance wise, right? The second home has to be, I think, and I may be wrong with this. I may be wrong, but I think it has to be at least 60 miles away or 70 miles away from the original home or something to that effect. You could have two homes in the same state, right? I could have a home in Orlando and have another home in the Keys, right? Because they're far enough apart for me to have two different homes in the same state. So it doesn't mean if you're going to have a second home, it has to be in a different state. Distance does come into play. You cannot lie and say you're going to live there when you don't work nowhere near there, unless you could prove you work remotely. The bank is going to find out, guys. Best to play it the safe way. So if you're going to do a second home, think about what you want to do with the second home. Maybe a second townhome, maybe a condo, whatever it is. Do you want to use it as an investment and then use it for a second home when it's not in use? Are you going to be using for most of the holidays when it's the busiest time to make most money if you're renting it out as short-term rental? There's a lot of things to consider. If you have any questions or need any help with this, give us a call, send us a text. My number should be somewhere up here, somewhere below, somewhere there. We do a lot of complimentary consultations on Zoom, or you could just give us a call, send us a text, let us know. We will arrange something to go over with you the details. But we do this a lot because we're in Central Florida. We're in the Disney World area. A lot of people have second homes here. A lot of people use their second home as investment properties. We're able to show you exactly how to do so. Thank you so much for watching. Remember to like and subscribe. I keep forgetting to say that. Remember to like and subscribe to our videos, guys. That way you'll keep getting more and more of them. All right? Thanks so much, guys. Love you. See you in the next video.